Hi everybody, this is Lara with your end of the week video for the S&P 500 for the trading week ending Friday 11th of June 2021. The trend for the S&P remains up and there are new all-time highs this week from price and the AD line. The next target is 4900. That's been the target for a while. Elliott wave analysis first, classic analysis last. This analysis expects that a cycle degree fifth wave began here and within it primary wave 1 is incomplete. This is a very bullish wave count, looking at the possibility of supercycle 5 to end grand supercycle 1, possibly to end in either March or October 2029, if the 2020s mirror the 1920s, and they have started out pretty much the same with a global pandemic. Primary wave 1 looks like it's subdividing as an impulse, with intermediate 1 and 2 complete. Intermediate 3 may only subdivide as an impulse, and a common Fibonacci ratio for a third wave is for it to reach 1.618, the length of its first. That would be achieved at 5469. This is a very, very bullish wave count. Intermediate 3 unfolding as an impulse with minor 1 and 2 complete. Minor 3 expected to be extending with minute 1, 2, 3, 4 complete, and I'm expecting an extended minute to fifth wave. When it arrives, then minor 4 may not move into minor wave 1 price territory, and when intermediate 4 arrives, it may not move into intermediate wave 1 price territory below 3588.11. Eventually, when primary wave 1 can be seen as a complete impulse, we should be also seeing some bearish divergence between price and the AD line at the eventual high, possibly also between swing highs between price and RSI, and I would prefer to see double bearish divergence there. If we see that set up, then I'll look for a possibly really deep primary degree second wave, which could meet the technical definition of a bear market and retrace more than 20% of market value. Eventually, when it arrives, it may not move beyond the start of primary wave 1. The long-term invalidation point for this wave count remains at 2191.86, but I don't expect primary wave 1 to be ending for many months yet. Let's take a look at the daily chart, where this low here, the end of minor 2, is this point here, and minor wave 3 so far looking like a really good impulse with 1, zigzag for 2, 3, expanded flat for 4, and possibly an extended fifth wave. Considering the target for minor wave 3 for it to reach 1.618, the length of minor 1 at 4900, minute wave 5 would have to be extended to reach that target. And for that reason, within minute 5, I'm labeling minuet 1 incomplete, with subminuet 1, 2, 3 winding up now to move toward through the middle in the next week or two. And so now that price is closed to a new all-time high on an upward day with support from volume, and it's followed by another green candlestick for Friday with a bit of a long lower wick, I expect some energy may now be released to the upside. We may now start to see an increase in momentum and possibly even some support from volume, and small caps are also showing strength. So there is a lot of support from classic technical analysis for this Elliott wave count. Within subminuet 3, no second wave correction may move beyond its start below 4061.41. Quite soon I'll be able to move the invalidation point up here to the end of subminuet 1, but only when the middle of the third wave has passed. When I see that on the hourly chart, then I'll move the invalidation point up to this high back down here. At the hourly chart level, here is the end of micro 2 and the start of micro 3 within subminuet 3 with submicro 1, 2, minuscule 1, 2, nano 1, 2. So we've got a series of now 1, 2, 3, 4, 5 overlapping first and second waves, winding up to move through the middle of a third wave. And so I expect upward momentum to increase. If minuscule 2 is not over, it can't move beyond the start of 1 below 4208.41. I do not have alternates for you this week. They are discarded based upon a very low probability and a lack of support from classic technical analysis. I did have one for you for the very short term for Thursday. That's now been discarded. For Friday, for this week, this is a weekly chart, we see some support now for upward movement. Well, at least it's increased beyond the prior week. On balance, volume also confirming new highs in price for this upward week, which has affected an upward breakout with support from volume at the daily chart level. We've got a couple of long bullish long lower wicks here, and they're pretty small, but they are long lower wicks on the last two candlesticks, well, on this candlestick anyway. RSI is again overbought, but this market has a really strong bullish bias. If you want to understand what I mean by that, go back and look at the 1990s up to that big high in 2000, the dot-com bubble. RSI reached deeply overbought and remained there for months, even years, while price continued higher. So RSI just dipping again into overbought doesn't mean we have to have a pullback here. There is really weak short-term bearish divergence, but I'm not going to give it weight because it's so weak. To give it weight, it needs to look clearer like this, and it just doesn't look clear at this stage. I expect it'll probably just disappear. Sometimes divergence is nullified. It's just another way of saying it just disappears and isn't followed by downward movement in the case of bearish divergence. ADX is declining at this time frame, telling us there's no clear trend. If it increases again, it would tell us there's an upward trend again. MACD gave us a bearish crossover last week. ATR is overall flat as price moves slowly higher. Absolutely normal behaviour for this market. Thursday, price closed on Thursday to a new all-time high above this prior high back here, and it did so on a day with some support from volume for upward movement. That is an upward breakout, and it has support from volume, so we should have confidence in it. So it's absolutely unsurprising that Friday has followed through with another upward day, a green candlestick with a little bit of a longer lower wick. Friday doesn't see support from volume though, but given the current market conditions, by which I mean for a long time price has been rising on light and declining volume, this is not of a concern. It's impressive in this market and given those conditions when we do see support from volume, but when we don't, I'm no longer for this particular market concerned. Well, we will be eventually, but not yet. ADX is below 15, too low to indicate a trend. If it reaches 15 and rises, it would then indicate an upward trend because the positive DX line is above the negative. On balance, volume has given us a nice bullish signal. It came after the breakout from price though. Sometimes it comes before, which is nice because it gives us a warning of what price may be about to do with a fairly high probability, but here it came after. This line is a horizontal. It's not too long held, but it has 4 tests, which is a reasonable number. So this break above resistance by on balance volume is a reasonable bullish signal, supporting again the Elliott wave count. RSI is in neutral territory, plenty of room for upward movement to continue. We saw short-term double bearish divergence with price back here, and it was followed by some downward movement and then some consolidation. Well, essentially price has been moving higher really since then, with little pullbacks along the way. Absolutely normal and to be expected. MACD bullish, stochastics overbought, no concern there. That can remain extreme for a long period of time. And I just keep leaving this here, the correlation coefficient between the S&P 500 and the US dollar index absolutely fluctuates fully through positive, right through the shaded area, right down to negative, and then it can move all the way back up into positive. I often see a lot of assumptions that because the US dollar is about to do whatever someone thinks it's about to do, that means the S&P must do some other thing because they're correlated. But the math between the two sets of data shows that they are absolutely not correlated at all. There's just absolutely no correlation there. If there is one from time to time, it is completely unreliable, cannot be relied upon. Okay, moving along, breadth and volatility to finish off this analysis. This week for the AD line, both price and the AD line are making new all-time highs. There is support from rising market breadth for this rise in price. This is very bullish. At the daily chart level also, new highs from price. I haven't noted it here, but there is a tiny little bit of bullish divergence for Friday. Price moved higher, but it didn't make a high beyond Thursday. The AD line has. It's so weak, I'm not noting it on the chart, but I will just mention it here as another tiny little bit of bullishness. But overall, with the strong rise in the AD line, this is very bullish, supporting the rise in price with underlying rising market breadth. This is the look of a healthy bull market, not the look of a bear market. Absolutely not. And it's certainly not giving any warnings that the bull market is about to end. Normally, a bear market is preceded by 4 to 6 months minimum bearish divergence between price and the AD line, and there is a positive correlation between the length of divergence and the severity of the following bear market, with a short divergence followed by a relatively weak bear market and a long divergence followed by a stronger, deeper bear market. With absolutely no divergence, actually the opposite. We had bullish divergence, the AD line making highs prior to price. This is the look of a healthy early stage bull market, not the look of a bear market. This is one reason why I'm so bullish with the S&P and have been for a long time. Price and inverted VIX. VIX is a measure of volatility of this market. Price has moved higher this week. Inverted VIX has not made a new midterm high. Short-term bearish divergence has simply disappeared as price moves higher, but there is still mid and long-term bearish divergence, over 3 years now of bearish divergence. It's proven to not be helpful as a timing tool. It's maybe one of the earliest warnings that this bull market will eventually end and turn into a bear market, as they all will eventually. And this kind of also fits the Elliott wave counter, seeing this market in a fifth wave. So there is some weakness within this market, or at least there is more volatility. Between VIX and VVIX this week, VVIX again has moved higher while VIX has moved a little bit lower. Volatility of VIX is elevated. There is now 2 weeks in a row of short-term bearish divergence here, but this is about the only real, well, I think it is the only bearishness I can find in this whole analysis. And of all of the signals I'm looking at, this is one of the least reliable, and so I am not giving it weight. At the daily chart level, inverted VIX makes a new short and midterm high, as does price. There is no short or midterm bearish divergence, well, no short or midterm divergence at the daily chart level between price and inverted VIX. Again, VIX has moved lower to make a new short-term low below this price swing low here, but VVIX is not. Volatility of VIX remains elevated. This is bearish for the short term. There's now a little cluster of bearishness here, but again, this is one of the least reliable signals that I'm looking at in my experience of using it so far, and so I am not going to give it weight, because the weight of bullishness from the AD line really does overshadow it. And that's my analysis for the S&P for you this week. Again, extremely bullish. I hope that all of our members are having a super awesome weekend.